So let's talk a little bit more about what's called the 6% rule and the 31% rule. Now, many business owners with the defined benefit plan understand that their 401k employer profit share contribution is now going to be limited to 6% of their compensation when they have the DB plan active. But many haven't heard of 31% rule. Could you discuss a little bit more about that rule and maybe give an example how that would work?
Yeah. So good question. So what happens is that, just to go over the 6% rule really quickly, typical profit sharing, let's assume an S Corp, you can do your deferral on a 401k, and then you can do a 25% profit sharing on the actual W-2. So if you've got a $100,000 W-2, you can do 25 grand in profit sharing. Well, the IRS limits that when you combine plans to 6%. Okay. So instead of doing the 25, you get 6. So you do lose a little bit of funding on your 401k side. Okay. Mm-hmm. But what you do is you end up picking up a large contribution on the defined benefit plan side. So obviously the DB plan contribution more than makes up for the loss on the profit sharing. Most clients are aware of this, or they've seen it, or they've heard about it, or they get it. But what the rule is, you either have to pass the 6% rule or the 31% rule. And the 31% is just the combined profit sharing and DB contribution can't exceed 31% of either 6% for the profit sharing or 31% combined. And so what you could conceivably do is you could put your profit sharing at 25%, and that would be $25,000 in that example. And then you could do $6,000 into a DB plan, and that would give you a total of 31 grand, which is 31%. So that would be compliant to do to kind of violate the 6% rule, right? Go over that on the profit sharing, but still meet the 31% rule, and it's either or. But what happens, Zach, is that we rarely use the 31% rule, right? Because for someone who only wants to get $6,000 in a DB plan, obviously there's fees, there's compliance, there's a lot of headaches, a lot more headaches involved in administering a DB plan. So why would you jump through all those hoops and pay us to administer a plan if you could only get $6 grand in? So it usually doesn't make a lot of sense. However, we do see it in years where if someone's income is down, or maybe they've really, really overfunded, and this is an opportunity for them to get their funding more in line by getting more into the profit sharing and then less into the cash balance plan. Again, not probably something you want to do long term, but for a year, every now and then to get your funding back in line could absolutely make some sense. So, we remind people often that the 31% rule is out there, and especially we recommend it if they've got a down year or if they're overfunded,
Yep, absolutely. That's very interesting, and a great tip for business owners if their DB plan ever becomes overfunded and they're unable to contribute as they normally would. Thanks, Paul.